Right, ladies and gents, cool. Let's get your attention. Did you have a good coffee break? Yes? Nice. You drinking water there. I'm very happy to see that. I'm also happy to see that a lot more of you have joined us now that it's 12 o'clock in the afternoon. We were missing some of you this morning. Some of you still looking a little bit tender after last night's festivities. But welcome to all of you guys. This is the part of the day, if you are a startup, if you're an entrepreneur, you want to get your pen and paper ready, guys, because we've got a very, very special keynote speaker right now who's going to talk about the importance of startup acts and global standard for investors and founders in the venture capital industry across Africa. That is a mouthful, but basically I think it's all about how can I get some money? That's what the man's going to talk about. That's what we want him to talk about. He's the co-founder and chief investment officer for Startup Bootcamp Africa. The man I'm talking about, of course, is Zach George. As I said, he's that co-founder. And he's also a leading multi-corporate backed venture accelerator, which is a multi-corporate backed venture accelerator program here in Africa. In 2013, he founded Cactus Advisors, which is a specialist corporate finance advisory firm and micro VC fund that has advised and invested in 40 plus of Africa's top tech ventures. He currently serves as a principal at Nedbank Venture Capital and Alternative Investments. He's the man you want to pay close attention to. And as I said, make some notes and get ready with those questions. Your keynote speaker right now, please make him feel welcome. It's Zach George.
Thank you. Thanks all. First of all, a big round of applause for Christoph and the entire team from AfricArena for putting together such a diverse group of panelists, speakers, juries. I think just an outstanding job doing this in the midst of the crisis. I really appreciate it. About 15 years ago, I was sitting at the back bench of the business school at Stanford, and there was a professor called Randy Komisar, who's now one of the principals at Kleiner Perkins, one of the top VC funds in the Valley, and he said something that completely shook the core of my being. And this was 16 years ago, so I'm sort of revealing how old I am. It's a good thing I still have hair. And he said, the most dangerous risk of all is the risk of not doing what you want, on the bet that you can buy yourself the time and the freedom to do it later. So without raising your hand, just a penny for your thoughts. How many of you are truly, madly and deeply, to quote Savage Garden, doing what you want to do with your life today and hoping that one day, when I'm 40 or 50 or 60, I'll do what I really want to do? Right, don't have to say yes or no, because I know the answer is no for most of us. But for entrepreneurs, they live that every day of their lives. They're not buying time. They're not buying resources. Yet they're living their dream as they speak. And that's why 10 years ago, when I came to Cape Town on a holiday to watch a bit of football with the World Cup, I said, there is so much potential for entrepreneurs on the continent of Africa to create a version of Silicon Valley here that suits the African ecosystem. And we cannot constantly buy time for them to achieve their goals. And there needs to be a radical change in the way startups are not just mentored or invested in, but also valued. And although I'm here to talk about the need for a Startup Act, it's important to understand why that needs to happen before laying in policies to make it happen. So a bit of backdrop here, and I'm sure a lot of you have heard this before. In the next 10 years, according to the UN, 1 in 2 babies born in the world will be born in Africa. Just let that sink in for a second. 1 in 2 babies born 10 years from now will be born in Africa. And 1 in 3 people on the planet in the next 60 years will live in Africa, right? So that's either a massive structural, environmental, and infrastructural challenge, or it's a huge opportunity. And I choose to see the glass half full. So out of the 20 largest cities in the world, 12 will be in Africa. And it's not the usual suspects like Johannesburg and Nairobi and Lagos. It's the Bamakos, it's the Kinshasas, it's the Kampalas of the world, right? So what are we doing as founders to change that narrative? And where can government, where can corporates help us with? And that's the backdrop to understand why we need some sort of a startup act, right? So as a lot of you know, 10 years ago, the word venture capital did not exist in the lexicon of people on this continent. There was, at best estimates, maybe about $20 million of venture on the continent of Africa. That number is sitting at about 2 billion, right? And as one of the early pioneers of angel investing in the VC ecosystem, one of the main reasons why that has grown so quickly in the last 10 years is because corporate Africa, but specifically insurers, retailers, telcos, and banks have understood that if you don't partner with founders of technology startups, you will lose market share. And that's one of the reasons why setting up an accelerator, setting up incubators is such an important part to creating pipeline. You can't just build a VC fund without creating and curating your own deal flow. So as a few of our speakers mentioned earlier, Africa is the only region in the world where the amount of VC activity actually went up this year. So from January to October this year, we've had a 25% increase in venture funding versus the same period last year. It's the only region in the entire world. So on the backdrop of this, what are some of the key attributes that make a region or a city a hotbed for innovation? Why is Silicon Valley, why is London, why is Tel Aviv, why is Bangalore, why are Beijing centers for innovation and not other cities in the same countries? What's wrong with Delhi? What's wrong with Johannesburg? What's wrong with New York? And these are 5 key components that make up a thriving startup ecosystem. And irrespective of what part of the world you live in, think about how these components affect you, right? So obviously, you've got to have very smart developers, designers. You've got to have tech entrepreneurs that can fuel innovation. But it's also important to take a step back and saying, what are our universities doing when graduates from top universities in your local ecosystem leave? Do they go up and take up jobs in academia? Do they consult to industry, or do they go and join startups? So the common thread in a lot of the world's top ecosystems is people leaving technical universities and joining ventures. You see that in Silicon Valley, you see that in Bangalore, you see that in Tel Aviv. You are slowly starting to see it in Cape Town. You're definitely seeing it in Lagos, right? The second thing here is risk capital. I did not say capital, I said risk capital. Why is that important? Because more than capital, it's your attitude to capital that really matters. The attitude to capital, unfortunately, in a lot of African countries is very, very old school. You see a lot of wealth. I mentioned this before. Stellenbosch has a higher wealth per capita than almost any region on the entire planet. But the attitude to capital is really, really, unfortunately, very risk-averse. But in ecosystems like Tel Aviv, New York, Bangalore, etc., the attitude to capital is more risk-taking. Some of the wealthiest people in Silicon Valley are under the age of 35 because the attitude to risk is different, and that needs to change. The importance of corporate startup collaboration. I'll touch on this a bit later, but the reality is it's very hard to scale a business in Africa or in emerging markets unless you solve for distribution. The cost of acquiring customers in Africa is exponentially higher than a similar venture in the US or in Europe. So it's so important as founders to learn how you can work with an insurer, a telco, a bank, a retailer. And you've got to understand how you can offer just enough of a carrot and an incentive to them, and understand that it's okay to lower your margins as entrepreneurs in exchange for higher volume. And that's something, I mean, as entrepreneurs, inherently we have this thing called confirmation bias, where we love what we do, but we forget to see the bigger picture. The smartest startups in Africa, and as an individual and as an accelerator, we've invested in more than 20 countries on the continent, is you have to understand B2B strategies. This is all relating to how a startup act is relevant. You need to have accelerators, and real accelerators that take equity and invest money with demo days, and not programs that claim to be accelerators that don't create actual value. And you need government support. We had Tim Harris here earlier. We had some folks from the government. Government is extremely important, but without being interfering. Government's role is to support, and how can government support? R&D grants, tax subsidies, programs that help with understanding IP, understanding legal processes, right? So if you look at the government of California, very, very supportive and pro-startups. The Western Cape, similar metrics. So you got to think, there is a reason why certain regions on the continent are more supportive of startups, because they've got better legislative processes. So where does all this lead to? In 2012, Italy was the first country in the world that created a Startup Act. And as many of you know, Tunisia was the first African country that created a Startup Act back in 2018. Senegal tried doing it. They haven't finalized it yet. And Mali, of all places, is likely the second country on the continent that is close to finalizing a Startup Act. What are some of the high-level features of Startup Act? So in Tunisia, if you're a startup in existence for 8 years or less, if you've got no more than 100 employees, so it's pretty later stage friendly, and no more than 2/3 of your shareholders, be they founders, angels, or hedge fund investors, what do you get from that? A, you'd pay no tax for up to 8 years. You have no capital gains tax. Salary for up to 3 founders, completely paid for. A 3-year tax holiday for founders, and government assistance and fast-tracking of international patents. Now, you're going to come to me and say, Zach, Tunisia has only 8 million people. It's easy for them. You got to start somewhere, right? Mali, similar act was passed late last year. Slightly different metrics, but similar intention. Government support, tax breaks, special assistance and scholarship to founders. Now the question here is, can this be scaled to other African countries? The short answer is yes. Can you create a universal startup act that covers 54 countries? A little bit more challenging. Why is that the case? A, 54 countries, 54 different payment methods, 54 different ways in which you have ownership. For example, a lot of folks here aren't aware of the fact that in certain East African countries, foreign nationals cannot own more than a certain percentage of a startup. There are huge implications around moving your IP outside of your local jurisdiction. So trying to have a startup act for the entire continent, as sexy and attractive as it may sound, is very hard to work in principle. But what's important is you need to have a basic set of non-negotiables from a funding perspective that has to be agreed upon. I call it the red list. So if you're a startup in Kenya or a startup in Cote d'Ivoire or in Tunisia or South Africa, you cannot accept terms from local, national, or African funds if it contravenes certain basic points. And I want to give a shout out to our friends at Digital Africa Collective and Endeavor that have spent a lot of time, thank you, Alison, for getting a laundry list of basic terms that you cannot accept. Because as founders, if our investors, our funds in Africa, are taking advantage of the fact that there is a supply-demand glut, specifically at pre-Series A, and you see predatory term sheets being sent out, it just does not benefit the entire ecosystem. The problem with a lot of VCs and founders is they try to build empires, not ecosystems. And the only thing about empires that we all know is what? They ultimately fail. So you've got to have, and the thing about Silicon Valley, and I lived there for many years before coming here, is that because there's a lot of supply of capital, you can't have one or two funds throw out ridiculous terms that destroy the ecosystem. So what we need is more African VC funds, more angels, more family offices, investing into startups so the playing field is leveled. So I'm going to quickly go through some of the fonts ridiculously small, but these slides are available. So as founders here, beware of certain terms that VCs send you. And this is a 2-hour discussion that I'm going to do in 5 minutes. Common shares, pref shares, right? Common shares are for founders. Pref shares are for institutional investors. Pref shares usually have something called a liquidation preference. If anyone dares send you a term sheet with anything more than a 1x liquidation preference, walk away. Right? I don't care who they are. As someone that's been arguably one of the most founder-friendly investors and VCs in Africa, trust me, walk away. Preferred returns. There is the evil clause called participating preferred. Please stay away from it. It used to happen in the 1980s and the 1990s when VC was just taken off. Participating preferred essentially means you can double dip. So someone gets a nice liquidation preference with preferred dividends, and they get to share in the upside upon conversion. So the norm is non-participating preferred and a 1x liquidation preference. In certain rare cases, if it's an exceptional VC with lots of strategic value, you can agree to a capped participation, which means they can double dip up to a certain extent. But trust me, they would have to be of the quality of Sequoia or Kleiner Perkins for you to accept those terms. A lot of things that don't get said often is when you hear stories of Goldman Sachs and US VC funds investing $20, $30 million into African startups like Kobo and Lori, what they don't tell you is what terms they offer, right? So it's a little known fact that Goldman's terms were way more than a 1x liquidation preference. You don't hear that in the press because it doesn't make headlines. And as a good VC friend of mine that does Pan-African deals once told me, as a VC, you make money on entry, not on exit. And as entrepreneurs, if you think you have won a battle with the VC when you have managed to lower your valuation down to something that you think is right, well, guess what? If I set the valuation, you set the terms. And terms are often a lot more important than what your valuation is. So I can have a ridiculously low valuation as a VC, but if my liquidation term is a lot higher, what's the purpose, right? So understand that. Always read the footnotes, and if you need to pay a lawyer to do it for you, do it. I'm not going to talk about pre-money, post-money. It's pretty standard. The one thing I want to talk about here is tag-along, drag-along is pretty standard. I want to talk a little bit about ratchets. Where is ratchets? Somewhere here. Yeah. Now, a lot of the, first of all, if you're a startup founder anywhere in Africa, right? Couple of things. I would highly, highly encourage you as founders to move your IP to investor-friendly jurisdictions as early as possible. By show of hands, what are the top 5 tech startups in Africa? Give me some names. Not South Africa, in Africa. Come on, give me some names. M-Pesa, Jumia, Paystack, Yoko, Flutterwave, Sendy, Aerobotics. The common thing about all these startups is their IP is held either in Delaware or the UK or Singapore or Mauritius, right? They don't talk about it because it doesn't make front page headlines, but they move their IP offshore very early for lots of reasons. Capital gains, better double taxation treaties between the IP holding company and the operating company. But the key thing to understand here is you can be very smart about how you structure your company and keep three people happy. Local governments, I'll give you an example of Flutterwave and Paystack, right? Two of Nigeria's largest fintechs. One of them got acquired recently. Both are in Delaware. They both create jobs locally in Nigeria, right? So the government's happy. They both pay the majority, in fact, they pay all their taxes in Nigeria, but the IP is held in Delaware. So investors are happy, government's happy because they receive tax money, and the economy is happy because you create jobs locally. So there really should not be a reason why, if you're smart as a founder, that you keep your IP in your local geography. It just is an inhibiting factor to your growth on day one. And of the 60+ investments that I've made into African tech ventures, almost 80% of them, the IP is always offshore. It's just being smart. So as founders, keep that in mind. And the next point to that is, if your IP is offshore, there's no reason for you to price your rounds before your Series A. To raise money through convertible notes, through safes, and kick the can down the road from a valuation standpoint. You're going to pay a lot of money to raise money through common equity and preferred equity, and it costs you literally $0 to raise money through a safe. We just invested $1 million last week into 4 companies, and it costs us $0 from a legal perspective because we did safes. The last thing I'll mention is on ratchets. Because valuation is a thorny issue, ratchets work both ways. What's a ratchet? A ratchet basically says, if we can't agree on a valuation, if you're doing a price round, which by the way you shouldn't do, I'm going to wrap up now. You can link your valuation to a multiple of revenue or some KPI upon conversion. So you can say, I'm going to give you $1 million at a valuation of $10 million, which is, at today's projections, 5 times your next 12 months revenue. 12 months from now, if I don't hit my revenue targets and I only do half of that, my equity ratchets down. But ratchets work both ways. If an investor says to you, I'm going to get you 10 clients and help you with your revenue to X, and if they don't do it, their equity ratchets up. So ratchets work both ways. Again, this is a one-day presentation. I'm trying to do it in 2 minutes. So just be aware of these terms. And I think as different African regions, we have to agree on certain basic non-negotiables and then work your way up. The very last thing, valuation. As much as I hate talking about valuation if you're pre-Series A, valuation is in no ways a function of how much funding you've received. I've seen hundreds of startups in Africa and across the world that have raised a lot of money but are worth diddly squat. And there are companies that have been around for many years that are worth nothing. And the opposite is also true, that have very high valuations that have been around for a few months. The only measure of how valued you are is validation. Do you have product market fit, number one? And do you have a validated problem solution fit? The market will price you in. All right, I'm going to stop there. Thank you for listening.
Thank you, Zach. In fact, no. Hold on to your microphone over there, Zach. Before we do any questions, we're gonna actually move on to the panel discussion because you are a part of our next panel as well. So we're gonna save the questions for the panel.